Hello everyone. In today's video, we will thoroughly explain how to use Dow theory in investing and trading. This video is for those who want to learn Dow theory from scratch, those who want to understand it systematically, or those who have heard of it but are unsure how to apply it. We'll present everything in an easy-to-understand way. If you're thinking, this sounds difficult, don't worry. Dow theory is the foundation for understanding the movements of market participants' psychology and interpreting chart patterns logically. Knowing this theory can help you identify key turning points in the market, such as the start, continuation, and reversal of trends. By the end of this video, you'll not only grasp the basics of Dow theory, but also understand how to apply it practically in investing and trading. Please stick with us until the end. Now let's dive right into the main topic. First, we'll explain what is Dow theory. In short, Dow theory is a market theory that articulates what trends are. It was developed in the early 20th century, quite a long time ago, but it's still a fundamental theory widely used in the world of investing and trading today. The person who created this theory is Charles Dow. He was originally a journalist and is also the founder of the famous Wall Street Journal and Dow Jones and Company. And the well-known Dow Jones Industrial Average was also devised by Charles Dow. Interestingly, Dow himself didn't publish Dow theory in a book. Instead, the theory was developed from articles he wrote in the Wall Street Journal over time. After his death, a person named William Peter Hamilton, along with his colleagues, systematically organized Dow's ideas and spread them as Dow theory. This means it's a highly trusted, time-tested theory. Furthermore, many of today's technical analysis methods are based on Dow theory. It's often said that the foundation is essential in any field, and in the world of investing and trading, especially when it comes to chart analysis, Dow theory is that foundation. Whether it's technical analysis or understanding investor psychology, the essence of it all is rooted in Dow theory. Now let's go through the 6 key elements that make up Dow theory. Dow theory consists of the following 6 basic concepts. 1. The market discounts all information. 2. There are 3 types of trends. 3. Trends have 3 phases. 4. Stock indices must confirm each other. 5. Trends must be supported by volume. 6. A trend will continue until a clear reversal signal occurs. Let's break these down one by one. To begin, the first principle, the market discounts all information. This concept is based on the idea that all available information is already reflected in the current price. Although Dow theory was initially developed with stock prices in mind, it can also be applied to other financial products like Forex or commodities. In other words, the prices of all products traded in the market already reflect all information from market participants' expectations, psychology, and external conditions. Additionally, when unexpected events occur, the market reacts quickly to incorporate them. For example, if geopolitical risks rise in the Middle East and oil prices spike, energy-related stocks may rise, and transportation stocks may fall, impacting the entire market. What's important here is that even potential future events can be anticipated and reflected in the market. For example, if there are rumors that a major IT company is about to announce a new generative AI service, even before an official announcement, related stocks may begin to rise in anticipation. The market reacts to these possibilities before they even happen. This is the principle behind the market discounts all information in Dow theory. Next, let's explore the second principle. There are 3 types of trends in the market: primary trend, secondary trend, and minor trend. Let's start with the primary trend. This is the major direction of the market, either an uptrend or a downtrend. If the market is in an uptrend, it's the main upward movement. If in a downtrend, it's the main downward movement. A primary trend typically lasts for a year or more. However, trends do not move in a straight line. For instance, during an uptrend, the price might temporarily dip, a pullback, before continuing its rise. On the other hand, in a downtrend, there could be short-term rallies, a correction, before the price resumes its decline. The price movements in the opposite direction, such as these pullbacks or corrections, are called secondary trends. Secondary trends last from a few weeks to several months. Finally, we have minor trends, which refer to small price fluctuations that happen daily or over a few weeks within the primary and secondary trends. You don't need to memorize the names of these trends, but understanding that the market has a larger movement, primary trend, with adjustments, secondary trend, and smaller daily fluctuations, minor trend, is essential. By recognizing this structure, you'll find it easier to understand what time frame the market is moving in. The third principle, the three phases of a trend, is critical, so I'll go into detail about it later in the video. Next, let's cover the fourth principle. Stock indices must confirm each other. This concept suggests that you should not judge a trend based on just one stock index. For example, in Dow theory, it's not considered a valid trend unless both the industrial index and the transportation index are moving in the same direction. The logic is that if manufacturing industries are doing well and stock prices are rising, the transportation sector should also benefit as they're responsible for moving goods. If one is rising while the other isn't, the trend is seen as weak or possibly temporary. If we apply this theory to modern markets, it could mean that if the S&P 500 is in an uptrend, but the Nasdaq is declining, the overall trend of the U.S. stock market might be questionable. In the case of Forex, if the usdjpy is rising, but other pairs like EUR, USD, AUD, USD are also showing strength in the dollar, we could confirm that the US dollar is in an uptrend. This principle emphasizes that it's crucial to check multiple related indices or pairs to confirm whether the trend is reliable. The fifth principle, trends must be supported by volume, will be explained next. This means that when a price rises or falls, the volume, trading activity, should also increase. For example, in an uptrend, the price should rise with increasing volume, while in a downtrend, the price should fall with increasing volume. This correlation between price and volume helps confirm the strength of the trend. At certain points, the price is rising alongside an increase in volume, which we interpret as a reliable rise according to Dow theory. By observing volume, you can determine whether the trend is genuine or not. The sixth and final principle, a trend will continue until a clear reversal signal occurs, is critically important, so I'll explain it next together with the third principle. Trends have three phases. These principles are the foundation of the market analysis videos I publish every week. I highly recommend you learn and master them. Now let's begin the explanation. First, let's look at the three phases of a trend. In Dow theory, trends are defined as having three phases. Here I will explain these phases for both uptrends and downtrends. The structure is almost the same for both, so I will first explain using an uptrend as an example. The first phase is the accumulation phase, meaning accumulation or gathering. During this phase, there is still no clear direction in the market as a whole, and only a small group of investors with foresight begins slowly accumulating positions. This phase is typically where professional investors or institutional investors start to build positions before the trend fully begins. Next is the participation phase, which means participation. During this phase, the direction of the trend becomes clearer, and general investors or traders using technical analysis start to participate in the market in full force. Trading volume increases and the momentum of the trend grows stronger. The third phase is the excess phase, which means overheating. In this phase, the market becomes overheated and many investors become overly bullish. The media also starts to focus on the trend. During this phase, new participants enter, while earlier investors who joined in the initial stages of the trend begin to take profits. By this point, prices are relatively high, but the buyers are latecomers, while the sellers have already secured enough profit. Understanding this market structure allows us to avoid entering at high price levels. By considering who is buying and who is selling, we can view the market more objectively. The trend often follows a 3 up, 3 down structure, known as 3 waves up and 3 waves down, which frequently appears in charts. Keep an eye out for these patterns in real market charts. Now let's move on to the sixth principle of Dow theory. A trend will continue until a clear reversal signal occurs. This is the most crucial aspect of Dow theory. It is a simple yet powerful principle that suggests it's better not to go against the trend as long as the trend continues. In other words, as long as the trend is either an uptrend, where higher highs and higher lows are being made, or a downtrend where lower highs and lower lows continue, the trend is considered to be ongoing. Conversely, when this pattern breaks down, it serves as a key signal of a potential trend reversal. For example, if the most recent low in an uptrend is breached, it suggests that the higher low pattern has been broken, indicating the end or reversal of the trend. Therefore, instead of prematurely selling or buying against the trend, it's important to follow the trend until clear signs indicate it's over. There are two major interpretations when it comes to trend reversal signals. Let me explain both. The first interpretation is based on the break of the support level or resistance level. The support level or push low refers to the most recent low that formed before a price increase in an uptrend. In this case, the support level is the low here. Once this low is breached, the uptrend is considered to have ended, and a downtrend is expected to start. The second interpretation focuses only on the lower highs and lower lows. Look at this high. It has failed to break the previous high. The confirmation of a lower high comes when this low is broken. When this low is breached, it confirms the pattern of lower highs and lower lows, signaling the start of a downtrend. The difference between this interpretation and the first one is that the second one does not focus on whether the support level has been breached. It sees the trend reversal when lower highs and lower lows are confirmed. What we need to focus on is not which interpretation is right or wrong, but rather how we can use this information in our trading. For example, you might think that the market is still bullish because the support level hasn't been broken yet, but traders who focus on lower highs and lower lows might already be leaning toward a bearish view. So how should you determine the timing of a trend reversal if you are just starting to learn this? The answer is to master the first pattern, the one on the left. This is because when the support level is broken, it shows that selling pressure has emerged. The second pattern on the right still holds some risk, as the support level hasn't been broken yet, so there's still a possibility for a rebound from that level. In the case of the second pattern, if you decide to sell, you need to set profit-taking levels in advance to avoid the price rebounding to your break-even point or resulting in a loss. So the first pattern is generally easier to master. Trying to combine both can lead to indecision. Therefore, it's best to start by mastering the left side pattern first. Once you've mastered the first pattern, you can move on to the second one, right side, which focuses on trend reversals from higher levels. That concludes today's detailed explanation of how to use Dow theory in trading. If you found this video helpful, I'd appreciate it if you could give it a thumbs up. See you next time in the next video.